Welcome to TalkTickers, your summary of the latest earnings calls. Today, we're breaking down the recent first quarter 2025 call from CMBT.
That's right. We've dug into the results presentation, the Q&A, all of it, to pull out the key bits, financials, operations, and what management's thinking about the future.
Think of this as your rapid download on what really matters from that call.
Exactly.
Okay, let's kick off with the snapshot, the basic numbers for Q1 2025. The reported net profit, well, it came in at roughly $40 million.
But, and this is pretty crucial, if you take out the capital gains, from selling ships and things like that,
right,
that number actually flips. It becomes a net loss of about minus $6 million.
So that really tells you the core shipping business itself, well, it faced some headwinds in those first 3 months.
Definitely. And we should also mention this quarter did include Golden Ocean's result.
Oh, yeah, that's new.
But only from March 12th. So you're only looking at, 19 days of their P&L in this quarter's figures.
And they flagged different depreciation bottles too, didn't they?
They did. Which, just makes comparing these specific Q1 numbers, well, it's not quite apples to apples with the past or even other companies right now.
Got it. Okay, what about financial flexibility, liquidity?
Yeah, liquidity, basically their cash position looked solid, $345 million at the end of March.
Okay, and looking ahead, that contract backlog number seemed impressive.
It really was. That's future revenue locked in, right? Close to $3 billion.
And they added $1 billion just in Q1.
$1 billion added in just 3 months. Yeah, pretty substantial.
And on the spending side, the new ships?
CapEx commitments stayed put at $2.2 billion. That's for all those vessels they've ordered.
And equity on total assets?
End of the quarter, just under 32%, 31.9% to be exact.
So, okay, putting it together, the Q1 numbers themselves, that loss without the gains and the EPS missing estimates, it suggests, well, a challenging start for the existing operations.
Right. It wasn't a stellar print for the core business in Q1.
But the call really pivoted pretty quickly to the big strategic moves and, the forward outlook.
Exactly. And one immediate financial thing tied to that was the decision not to pay a dividend for Q1 2025.
Which makes sense, right? Given the CapEx and these big plans.
Yeah, they need the capital for the new ships, and especially for these major initiatives they're working on.
Absolutely. Which brings us right to those big strategic moves. The headline news everyone's watching is CMB.TECH buying Hemin's stake in Golden Ocean.
That's the groundwork, yeah. The key step for that proposed merger they're aiming for.
And on the commercial side, they locked in some really significant long-term deals.
Huge deals. One with Forest for an ammonia-powered Newcastle Max. But even bigger, maybe, is that agreement with MOL.
That's the one for 3 ammonia Newcastle Maxes and 6 chemical tankers.
Yeah, and those chemical tankers are either ammonia-ready or will be fully ammonia-powered. That's a landmark agreement, really.
Getting those kinds of contracts, especially for the, next-gen fuel ships, that seems core to their strategy.
Totally. They also kept taking deliveries 5 new vessels this quarter, 4 dry bulk carriers, and 1 CTV.
A crew transfer vessel, right, for offshore wind.
Exactly. And at the same time, they're actively selling off some older assets. The divestment program.
Right, the VCCs.
Yeah, sold 3 very large crude carriers. They expect that to bring in nearly $100 million in profit over the next 2 quarters.
Wow.
Plus, they finalized the sale of 2 other ships, the Kaplora and Alzo's Winot 6. That already generated a $46 million capital gain back in Q1.
So that asset rotation, it seems key, generates cash, books profits, and modernizes the fleet all at once.
Precisely.
Speaking of the fleet, where does it stand now? And where's it heading with all these new builds?
Okay, so right now, 113 vessels on the water. But remember that $2.2 billion CapEx?
Yeah.
That's tied to 46 new ships still under construction.
46? That's quite an order book.
It is. So their forecast is to hit 131 ships by the end of this year, 2025, and then grow to around 150 vessels by the end of 2026.
That's pretty significant growth in, well, not a lot of time.
It is. And generally, these are younger, more fuel-efficient ships coming in. So let's look at earnings. How did the ships actually perform in Q1 versus what they're seeing so far in Q2?
Okay, let's start with tankers.
Right, tankers. Q1 averaged $40,000 a day. Quarter to date for Q2 is looking a bit better, around $43,000 a day.
And how's that broken down?
Well, their big VCCs are fixed around $40K. The Suezmax is around $42K for about 2/3 of the available days so far in Q2. So steady.
Oh, dry bulk. Those Newcastle Maxes had a tougher Q1, right?
Yeah, Q1 averaged only $18,000 a day. And they did note that was actually below their P&L break-even point.
Ouch. So losing money on a daily basis just running the ship?
Yeah, essentially, yes.
Yeah.
But here's the turnaround Q2. Quarter to date, those rates have jumped significantly, averaging $24,000 a day for about 3/4 of the days they've fixed so far.
It's a big improvement.
It is. And what's really interesting is they highlighted these modern, efficient Newcastlemaxes are actually earning about 40% more than the benchmark Baltic 5TC index.
So that efficiency is really paying off now that the market's stronger.
Exactly. That's where you see the benefit.
What about containers and chemical tankers?
Mostly stable. They're largely fixed on long-term contracts at, good rates. That provides a solid base.
Any spot exposure there?
Not much. Chemical tanker spot rates, for the few they have, were still near $20,000 a day, which is decent.
And the offshore market, those CTVs.
We're seeing an uptick there too. Earnings are improving as that whole offshore wind sector keeps growing.
Okay, so clearly the big strategic piece overshadowing everything is that proposed merger with Golden Ocean.
Absolutely. Management's framing it as creating a, quote, leading diversified maritime group.
And the scale would be massive if it goes through.
Huge. Combined fleet, 250 vessels, that's about 200 already on the water, plus those 50 new builds across both companies.
And the backlog stays at $3 billion combined.
Yeah, the combined backlog consolidates to that $3 billion figure.
And tying into their strategy, a third of the fleet ammonia or hydrogen powered?
Roughly 1/3, yeah. That's the projection. It would make it one of the, most decarbonization-focused fleets out there. And very young, too, average age only 6 years.
What about the financials of this potential giant?
Well, they estimate the total fleet fair market value at around $11.1 billion. And they projected the NAV per share net asset value.
Right, the value of assets minus debt per share.
Exactly. That would be close to $15, assuming the merger completes.
And the CapEx commitments, do they jump up a lot?
Not dramatically.
Yeah.
Still around that $2.2 billion mark, mainly because Golden Ocean doesn't really have much of an order book right now.
Listings would be New York, Brussels.
And they're applying for Oslo Børs as well.
And structurally, the big change is dry bulk becomes the core.
Yeah, adding Golden Ocean's 91 vessels makes dry bulk the biggest division by far in the combined company, a major shift in profile.
That's a fundamental change. What about combined operating days?
They projected 55,000 ship days in 2025, assuming the merger happens soon, growing to over 62,000 days in 2026. And about 18% of those 2026 days are already covered by time charter.
Stable income base. And they gave some cash flow scenarios, too.
They did. Pro forma free cash flow for 2025. Combined entity, excluding more ship sales. Low case, $250 million. Base case, $500 million. High case, $750 million.
And that's mostly driven by the bigger ships.
Heavily skewed towards VCCs, Suezmaxes, and the Capesize bulkers, yeah.
And importantly, even that low case.
Right, the $250 million low case, they pointed out that roughly matches their yearly unfunded CapEx needs. The equity portion they plan to pay in cash for the new ships, which is around $250 million a year.
So even in a tough market, operations could cover the equity needed for new builds.
That's the message. Plus, any cash in those extra vessel sales, like that $100 million profit expected, that provides an additional buffer.
And they expect 2026 to be even better, potentially.
Yeah, they noted more Cape days expected in 2026, which could push cash generation higher, maybe above that base case.
Okay, let's shift gears. Huge theme in the industry right now. Decarbonization, regulation. They spent a lot of time on IMO MEPC 83 or IMO 2028.
A really significant part of the call. MEPC 83, it's been voted on, final ratification expected in October. It's seen as a very strong move by the IMO.
Focusing on fuel intensity, right? Not just slow steaming.
Exactly. It's about carbon per ton mile, basically. Slow steaming alone won't cut it. Ships will have to blend biofuels or use other low carbon fuels.
And there's a tiered penalty system.
Yeah. Starting 2028, there's a green tier for compliance, say 70% reduction by then. Fall short, you hit tier 1 deficit, maybe only a 4% reduction achieved, and you pay a penalty. Initially, $100 per ton of CO2 equivalent.
And worse is tier 2.
Right. Tier 2 deficit, less than 4% reduction. The penalty jumps to $300 per ton CO2. And these penalties ramp up over time, out to 2050.
And 1 ton of fuel is about 3 tons of CO2.
Roughly, yeah. That was the helpful clarification they gave.
So how does this translate into fuel costs? They talked about tipping points.
They did. Based on industry forecasts, they see a major tipping point around 2032. That's when running traditional fuel, say LSFO, blended with biodiesel, becomes roughly cost equivalent to running LSFO, plus paying the penalties, plus the cost of adopting green ammonia.
Okay, so parity around 2032, but then ammonia pulls ahead.
That's their projection. Around 2038, they estimate dual-fueled ammonia ships will actually have lower total bunker bills, lower fuel costs than ships running on LNG or that LSFO biodiesel blend.
And this depends on ammonia prices, obviously.
Hugely. These forecasts assume relatively high green ammonia prices, like over $2,000 a ton equivalent. If ammonia actually becomes available cheaper, say closer to $1,000 a ton.
Which some sources suggest might happen.
Right. If that happens, these tipping points could arrive much, much sooner. Maybe 2029 or 2030 for ammonia to beat diesel blends, or 2032, 2033 to beat LNG alternatives.
Which really strengthens the case for ordering those ammonia dual-fuel ships now.
Exactly. They even showed a calculation suggesting an ammonia ship ordered today, delivered maybe 2028, operating for 20 years. It could generate about $70 million more over its lifetime compared to running on biodiesel or LNG, even using those conservative higher ammonia price forecasts.
So this regulatory push really validates their strategic bet on ammonia.
It feels like it does, yeah. They mentioned customers are already actively calling them about ammonia-ready or fully fitted vessels.
And they're talking about retrofits, too.
Yeah, engaging with customers about potentially retrofitting existing ships, because now there are clear deadlines and visible cost savings potentially.
Quick points from the Q&A on this. Winged partnership isn't exclusive.
Nope, they can work with MN or others. First fully fitted ammonia ship, delivery Jan 2026. World's first ammonia Newcastle Max.
And the MOL ships, where will they trade?
Not defined yet, but likely major routes: Australia, Brazil, Africa, Europe.
And smaller ships, Kamsarmaxes, CSOVs.
They see ammonia as the fuel for Kamsarmaxes. Hydrogen probably makes more sense for CSOVs, shorter routes, regional patterns.
But the long-term focus is clear. Ammonia and hydrogen.
Very clear. Not methanol or LNG in their view. Those are the key molecules.
Okay, let's switch again. Market outlooks, segment by segment. Start with crude oil tankers.
Positive outlook here. Ton-mile growth forecasts are kind of flat for 25-foot 26, but the supply side looks really good for owners.
Why is that?
Order book is historically low, like 7-8%. And the existing global fleet is getting old. So tight supply should support freight rates.
Demand's still growing.
They expect oil demand to grow overall, even with some economic headwinds. And any disconnect between production and consumption, meaning more oil stored on tankers, that's also good for tanker demand.
What about Iran? Sanctions?
Any change could be positive, oddly. More sanctions might push trade to conventional ships. Fewer sanctions might push the dark fleet out, benefiting conventional ships. Either way, potentially good for their fleet.
And OPEC?
They see the narrative shifting to gradually unwinding cuts, adding maybe 2.2 million barrels a day back by November. That's good for volumes. The flip side is oil prices have dropped recently and the forward curve is lower.
Okay, dry bulk. This becomes their biggest segment post-merger outlook.
They see H1 2025 as a bit muted, but expect a much stronger second half and then a good run through 2026 and 2027.
Same story on supply. Low order book, aging fleet.
Exactly. Especially low for the big Cape-size ships. But the really key thing they highlighted is the special survey crunch.
Right, the mandatory overhauls.
Yeah. They estimate over the next 3 years, roughly a quarter of the entire global dry bulk fleet needs its second or third special survey. These take ships out of service for weeks, sometimes months.
So that's a huge chunk of capacity effectively removed from the market temporarily.
A significant enforced capacity reduction layered on top of the low order book.
Sounds like a recipe for tight supply. What about demand?
Looking positive. Iron ore, especially from Brazil and Guinea to the Atlantic. Australia recovering post-weather. Coal to India, China, still supportive. Healthy grain trade for smaller sizes, too.
And their big bet on Golden Ocean reflects this bullish view.
Clearly. They expect better utilization, higher rates translating from that stronger second half onwards into 26 and 27.
Container shipping, more cautious there.
Definitely more cautious, yeah. Short term, next year or two. Key issues. Uncertainty around U.S. tariffs that affects about 8% of container miles. Currently suspended, but who knows?
And the Red Sea situation.
Right. If there's a peace deal in Yemen, ships go back through Suez. Transit times drop, meaning less ship capacity is needed overall. Fewer ton miles.
Combine that with a huge container ship order book.
Yeah, around 30% of the existing fleet is on order. So, reasons to be cautious.
But they don't have spot exposure here anyway.
No, currently all their container ships, 4 on water, 1 coming, are on long-term charters. They said they'll wait for the right moment, better supply demand, before reinvesting more here.
Chemical tankers also moved to cautious.
Slightly more cautious, yeah. They're seeing some product tankers, Miss-Rs, dipping into the chemical trades. Order book is reasonable, but demand isn't super strong. That puts some downward pressure on rates.
But spot earnings still okay.
Still respectable, yeah. Close to 20 K a day for their spot vessels. And again, most of their chemical fleet is covered. 4 on charter now, 10 more coming that are already fixed long term.
Lastly, offshore wind. CNIVs and CSOVs.
Positive outlook there. Healthy growth expected in Europe, 15% this year, 22% next year. Asia picking up too.
Supply keeping up.
Fleet's growing, but they expect demand for these specialized vessels to outpace supply. They've got 3 large CSOVs delivering soon, this year, early next.
Okay, quick update on Namibia, the hydrogen ammonia projects.
Not a ton of new news, but confirmation things are moving. The hydrogen production station is nearly done. First H2 molecule is expected soon. A small ammonia plant might follow that.
And the big ammonia terminal?
Still active. They're doing detailed engineering work for that terminal in Walvis Bay. The PV2 fuel project also proceeding as planned.
Their philosophy seems to be start small, prove it works, then scale.
Exactly. Clear, working projects first, supply local users, then build bigger.
And the Golden Ocean merger, does it help or hurt funding for Namibia?
They argued it helps. Bigger balance sheet, more liquid stock, better access to capital from the combined entity should actually make it easier to fund and accelerate Namibia, not hinder it.
We should get more specifics on Namibia CapEx in the next call.
End of August, yeah. That's what they indicated.
Okay, let's mop up some other Q&A points. Shipyards, any impact from U.S.-China tensions?
They see limited impact for their specific orders, but did acknowledge some general owner reluctance about ordering in China right now, due to uncertainty. Defense orders aren't blocking commercial slots currently, they said.
Press rumors about new VCCC Suezmax orders.
Flat denial. Said they haven't ordered any.
Treasury shares, they hold a lot.
Yeah, but cheap. They're keeping them, not canceling. Potentially for transactions, could be used for Golden Ocean or maybe something else down the line.
Availability of green ammonia hydrogen. The big supply question.
They acknowledged it's slow now, but accelerating over the next 5 years. It's that classic chicken and egg problem, right?
Producers want demand certainty. Shippers need supply certainty.
Exactly. They feel shipping demand can help push producers to make those final investment decisions. And they see it as an and story. Both ammonia and hydrogen will be needed, depending on region and timing.
Small free float concern for CMB.TECH stock.
Merger fixes that, basically. Golden Ocean deal would take the public free float from around 8%, now up to about 38% in the combined company. Much better liquidity.
Any interest in LNG ships or other segments?
LNG, no interest right now. Order book is just too high industry-wide. Other segments, yeah, possibly, but only opportunistically if the investment case stacks up.
Okay, so summing up the call, it really gives you insight into how a major player is navigating things. Mixed current markets, big strategic M&A, and this huge long-term shift to decarbonization.
Yeah. Understanding their segment views, bullish tankers, dry bulk offshore, cautious containers chemicals is pretty crucial for evaluating where they sit.
And the pro forma cash flow discussion, showing they can likely cover CapEx even in a down market, highlights their financial strategy for managing that big order book and new projects like Namibia.
Plus, that whole IMO 2028 and ammonia discussion wasn't just theoretical. It was concrete regulations, timelines, cost impacts, how it affects their business case. Really interesting stuff.
All right, this is TalkTickers, so it must be time for our This Is Not Financial Advice segment.
Yeah.
Purely based on this call, what's an outrageous but plausible trade idea?
Okay, let's lean into that dry bulk story, specifically the supply side crunch they talked about.
The special survey crunch.
Exactly. So the idea, consider a long position in maybe some select dry bulk equities or perhaps even far-dated Cape-size futures, like looking out to late 2026, maybe even 2027 contracts.
That feels pretty far out to bet on maintenance cycles.
It is. That's the slightly outrageous part. But the plausible rationale is directly tied to what management said. Roughly a quarter of the fleet needing significant time out of service over the next 3 years.
On top of low new builds and an aging fleet.
Right. So if demand holds up or improves like they expect from H225 onwards, this enforced supply reduction from surveys could cause a much sharper spike in rates and utilization than maybe the market is pricing in today.
So you're betting specifically on that supply bottleneck as a catalyst.
Exactly. It's an angle beyond just general market optimism, betting on that structural squeeze.
Okay, but once again, absolutely not financial advice. Do your own research. All investments carry risk.
Definitely. So final takeaways from the CMBT call. The Golden Ocean merger, if it happens, is transformational. Creates a diversified, giant, young fleet, real scale.
Q1 had softness, especially X gains, but management is clearly bullish on tankers and dry bulk for the rest of this year and into 26-27. Supply dynamics look favorable, plus that survey crunch factor in dry bulk.
They're financially flexible, diverse operations, backlog, ship sales help, and they see the merger actually boosting their ability to fund growth, including Namibia.
And that commitment to decarbonization, particularly ammonia, looks increasingly solid with the IMO 2028 regs providing tailwinds and clearer economics.
Right. So here's a final thought to leave you with, building on that decarbonization piece. Management talked about the chicken and egg problem for green fuels like ammonia.
Supply versus demand.
Yeah. How quickly do you think that gets resolved? What happens if ammonia supply accelerates even faster than current forecasts suggest? What would that do to the competitive landscape and the value of these cutting-edge ammonia-fueled ships, maybe even sooner than they projected?
Something to think about.
Definitely. Thanks for tuning in. We'll catch you next time on TalkTickers for another earnings call deep dive.